What is up, everybody? Welcome to Why Invest Wednesday. We're starting a little bit earlier today. Sorry, having a little technical difficulties. A little early, I guess, here. So, yeah, super excited to dive into this one today just because we are absolutely at a point where we are talking about something that I'm so excited about as far as equity and building equity in our homes. This is obviously something that I have done personally, and I can't wait to kind of share a lot of it with you guys. Now, I do need to get this other one rolling, but that should be here pretty quickly. So thanks so much for popping on. And we can get rolling. Well, national headlines are all about, 3% interest rates and all of the things, and HELOCs are over 9%. There is so many options when it comes to leveraging your equity. While we have so much debt as Americans, as consumers, than we've ever had, and a lot of that's on the financial side, credit card debt, car loans, those kind of stuff, what most would consider short-term debt. We do have long-term debt within our homes if we own our homes, and that's where the equity leveraging can come into play, and it can be a game changer. And I'm going to go through a ton of different ideas, but at the end of the day, the plan is to help you build equity through real estate, and that's exactly what we're going to do today. Is we're going to dive into that. We're going to talk about my story and go from there. I am a real estate investor since the age of 19, and have absolutely, enjoyed the fruits of that labor. So as we kind of build here, we are going to get that rolling. So if you are new to the channel, watching this for the first time, sorry about the technical difficulties, but we do go live every single Wednesday with Mile High Market Mastery, where we're talking about specific strategies on everything that's going on, not things that are just kind of fly by night, but things that I have seen in the market, boots on the ground. And today we're talking about one that's near and dear to my heart, and that's building wealth through real estate using your equity. So if you like what you hear, please like the video, give me a comment. If you're watching this live or even, post live, you can ask questions. I will get to them on a later date or reach out to you directly in order to, get that question answered. So as we kind of move here, we got to talk first about the equity position that we are in. If you've bought a home or you've owned a home for the last 5 to 7 years, whether you've sold that home, whether you just bought it, 5 years ago, you have been part of some record-breaking appreciation gain, which is awesome. But we've also, seen a lot of, people that we've seen a lot of hit to the affordability side as we've seen the interest rates go up, because within that time frame, and part of the reason that we had such explosive appreciation in our real estate market is because the interest rates were held extremely low, right? Some people got refinances in the 2s, most people in the 3s and 4s. And so though that really helped our affordability and offset the ability for people to, spend a ton of money, 100,000 over, whatever that looks like. And so as we kind of step back now as homeowners, most people are in a situation where that equity, if you did own a home for the last 5 to 7 years, is likely the biggest, savings account that you have. While it is not liquid, it is a large asset and something that we can do. Certainly, if you have Bitcoin or you've been, hitting it hard on the stock market, you've seen, some similar gains if you've played your chips right. But in real estate, we're going to kind of stick to leveraging real estate for real estate to kind of go through there. There are a couple different strategies that I will share that include some of the short-term debt and that kind of stuff. But here's the situation. Most people that have mortgages on their home were able, that bought 5 to 7 years ago, were able to either get a really good rate when they bought, or were able to refinance when those rates did dip down. And so even if you had a low down payment, an FHA, or maybe even a down payment assistance loan, that appreciation far outgained, anything that you would have to pay back and so on. So a lot of people are in an equity rich situation. And so what that looks like now, especially for those that were first time home buyers and maybe just bought, a house that was good enough for them then, because it was very competitive and it was very hard to get in. Maybe they settled on a 3-2 when really they wanted to have a big family, and they considered it a 2 to 5 year plan. Well, if you considered it a 2 to 5 year plan, well, you're still in that 2 to 5 year plan barely if it was 5 to 7 years ago, but it's looking more and more difficult to get into the other home and swallow that payment, as taxes, insurance, and interest rates have all climbed pretty dramatically since that time. Now, taxes and insurance, you're kind of absorbing as you go as a property owner, but the interest rate is a major variable that's very different. And so a lot of people are stepping back saying, okay, well, like, I'm stuck here. Like, what can I do? And in the meantime, the economy's been so funky, inflation's been so funky, that maybe we have, dialed up a little bit of credit card debt, or maybe we did need a new car and we listened to our realtor and our mortgage broker and waited to buy the new car until after we were in the house. So all of those things kind of come into play when we're looking at the big picture. And so for real estate as an investment purpose, I've kind of lived through a little bit of it, and I've made some choices that unfortunately didn't, or fortunately didn't come to fruition. So I bought my first house when I was 19. We bought it for $195 or so, $198, I think, in Fort Collins. I rented that home out. I lived in it as a college student. And then when I graduated college, we tried to sell it. And the market at that time, it was 2006. It wasn't, anything. I'm sorry. Yeah, it was 2006 when I graduated. So it wasn't anything crazy. We didn't have mass appreciation. So we were pretty much going to break even. The house was in not as good of shape as it should have been, because I was a pretty hard tenant on it in my college years. And we weren't able to sell it to break even. Well, that luck changed my entire trajectory for my real estate investment journey, right? Because we were able to do that. Okay. In 2008, as you know, we had some issues, but Fort Collins wasn't necessarily majorly affected by that. We were in a good loan. We were able to do what we had to do. We rented it out. I think even during those harder times, maybe I paid $150 to $300 a month in addition. So I was, cash flow negative for a bit on there. But then after we got through that, it completely exploded, right? The market completely exploded. So what we were able to do eventually, I was able to refinance it. I was able to extend my note back to the 30 years. And I think probably that was, maybe probably 6, 7, 8 years into the mortgage. So we certainly did extend that out. And that's where it's really important for people to understand. Yes, if you've been in your loan for 5, 10, 15, 20 years, and you're just going to, clicking a button and getting a refinance and not asking the questions, they're just going to throw you in a new 30-year fixed. Well, if you have a smaller payment and then you extend out 30 more years, if you have a smaller principal because you've bought down a little bit of that, and then you extend that principal out 30 more years, well, your payment's naturally going to go down. So some people are like, oh, I can save you $300, $400, $500, $700 a month. What they're really doing is just taking the time that you've done and getting closer to your payoff and just extending it out, right? So the principal goes down every time you pay, even if it's a small amount at the beginning. Okay. And so the principal is smaller than when you started, and it's using the equity as the down payment as the leverage, but then they're taking all those months that you've paid and just basically putting another 30-year note on that. If you're not asking the questions, you're not asking about a 15-year and so on. So it re-amortizes over 30 years. So yes, your payment's going to go down because it's less money over a longer period of, or the same period of time that, when you started. And then it's just a waiting game if it offsets the interest rate costs and all of that. So make sure you're paying attention to that, because I've heard a lot of people just say, hey, like, I'm going to refinance my home and my payment's going to go down. Well, your payment's going to go down, but you're going to extend the term on it, which means that the debt is actually, you're paying more interest on the debt versus, you've already gotten the first 5-10 years out of the way, which is interest heavy, as on the amortization on a 30-year fixed. And so there's a lot of questions you need to ask yourself, and you need to make sure that you're not just, clicking buttons and refinancing just because there is also an additional cost to that. Whatever the cost is, usually it's around $5,000. I know there's all kinds of free refis out there and things like that if you bought in the last 3-4 years, but you need to make sure you're understanding the real terms of the loan and what you're doing to your long-term debt. So that's huge. So now we have a problem, right? We have a lot of consumer debt. We have some good debt in real estate, but all of our savings, so to speak, is probably in our homes, right? The consumer savings amount is at the lowest it's ever been, and the credit card debt or the debt is at the highest it's ever been. So that's a problem. That's a huge gap. But as someone who needs to move forward in life, because you need a bigger house, you need a smaller house, you need something, right? Or you need to start preparing and, diversifying your assets so that you're, more prepared for retirement. No matter what, if you're a primary homeowner, you're in a situation where you're looking, you're like, well, I have this 2 or 3% interest rate, and, that's good. I'll never get rid of that. But over here, you're building up debt possibly, or you're like, well, I need that money so I can buy, I can buy 2 houses, right? But I want to stay where I'm at, or, this is such a good opportunity. And so there comes 2 different options at this point. There are multiple others, but we'll talk in generalities here. You can do a cash out refinance, which is basically taking some of the equity that you have and turning it into cash. Typically, the cash out refinance interest rates aren't, the prime rates that they're talking about when you see all these people talking about the interest rates going, low 6s, whatever. So they usually add on some interest to that because you're increasing the loan to value, which is increasing their risk depending on what it is. Primary residence HELOCs, I've seen people go up to 90-10, so you can take, 90% of the value out as a loan. So that's a little bit risky, right? When we're in this, kind of weird time where it seems like the big numbers are saying we're staying flat or appreciating a little bit, but the neighbor's house might not be able to sell for what the next door neighbor's house sold for last week. So we have to understand that when we're looking at appreciation numbers, it's on a mass scale and it's not just one thing. So as we're looking at it, we're like, okay, well, I don't have a lot of debt, and this is the best case scenario because I want to help you buy more real estate to build wealth like I have done. But I just, I can't save as much because eggs are expensive and all of that. So how am I going to get to that, 20% down that is required for, a down payment? Okay. And you have options, right? 20% down on a really nice 3-bed, 2-bath rental home in the Midwest is a lot less than, something here in Denver, Colorado. So you can go into other markets. There is risk and reward to that, right? The reward is maybe you need, $50K down for a 25% on a $200,000 duplex. Okay. Here, starter level duplex is $500,000-$600,000, and it probably needs work. And you need, 25% of that, which is $100,000 on a $500,000 loan. Actually, it's more than that. 125,000 on a $500,000 loan. I'll just do the math real quick so we make sure we're good. Yep, 125,000 down. So yeah, 50,000 maybe is possible. 125, maybe not, or maybe neither are because of where we're at and your comfortability, and you want to keep some emergency fund, rainy day fund. And so you're like, okay, well, I got this equity. Well, that's where things can get really interesting. And we're going to go into this. So, leveraging your equity is an opportunity for you to do a lot of things, right? You can, first off, use equity in your home to do renovations. That's pretty much the home equity line of credit is made for that. Now, there's two schools of thought of this. You can leverage your equity when you're doing a HELOC. Most HELOCs will, the rule is that it goes towards the home you're living in. So I'm not here to tell you you can do that, you can't do that. Make sure you're being honest on your application and what you're doing. But if we step back here and we're talking about debt, and getting rid of some debt, people sometimes pull out debt on a HELOC at a lower interest rate than their credit card and personal loan. So that's the strategy too, is kind of to annihilate debt. And strategy number 3 is to multiply your wealth and use the equity to purchase another home, right? And so make sure you're following the rules on all the HELOCs and all of that. I'm not here to tell you, you can do this or you can't do this. I know there's certain stipulations, but let's talk about strategy 1. Let's say you've got $150,000 in equity sitting in your Lakewood home, right? And you open a $50,000 HELOC at 7.9% interest. Okay. There's all kinds. There's actually a HELOC in Colorado that's down to 5.9. If you DM me, I'll make sure I connect you with that, bank. And that's at the time of this recording. So it's not promised. I'm not quoting your rate, but that's just, what came across in my research. So, as we kind of look at this, you decide you want to remodel your kitchen for a $30,000 investment. You call me and I say, okay, well, yeah, if you do all of this and if that's what you're going to do to your kitchen, it'll raise your value $45,000 because you're going to take care of this. This now becomes something that's an upgrade, an update versus something that's an eyesore or or a regression in price. So, say you're going to remodel your kitchen for $30K, it's going to grow your investment $45K. Okay. Maybe you're going to refresh your, bathrooms, 20,000 investments going to add 25K investment. I would say that's pretty accurate. If your bathrooms look nicer and sharper, you're probably going to get a little bit more, but it's not going to be anything crazy. As you can see, kitchens are a little bit more return on investment. So your total cost is $50,000. You have $30K into the kitchen, $20K into your bathrooms. Total value added is, $45K for the kitchen and $25K. Therefore, you're gaining $20,000 even after interest costs, right? So that's pretty cool, right? You can utilize that. You can play the game. I would highly, highly suggest, if you're using a HELOC or you're getting a, lease through solar or whatever, just reach out to me and ask me, like, what's the return on investment? What's the best way to spend this money? Because a lot of people will say, okay, yeah, we're going to do it. And then I'm going to talk you through, like, okay, what are we doing here? I have clients that have very unique tastes and they're very, set on their ways and what they like. And sometimes I have to say, well, what's your long-term strategy, right? How long are you going to be in this home? If you're going to be in the home for more than 5 to 7, 10 years, like, do whatever. We'll probably have to update it before we sell it anyways. So the return on investment isn't as important. However, if you're looking to grow a family or you're looking to downsize at some point or whatever situation you're in the future, if you just go out there and you are like, okay, I'm going to go do this. Like, I'm going to paint the walls orange and I'm going to use glass tile here and whatever. Sorry if I called you out, if you know who you are. But I'm going to say, well, that's going to, be awesome for you, but the person coming in buying your home probably isn't going to matter. Or maybe you're like, yeah, we're going to turn this home into a rental. So we want to make sure we're doing top-notch, like bulletproof upgrades and not like something that's crazy, the vanity stuff, the pretty stuff. We want to make sure that it's more quality and it's going to stand the test of time, because no one will take care of your home, even if you have the best tenant in the world, as well as you will. So those are very important kind of pieces to talk about when you are renovating. If you're interested, definitely comment renovation below or shoot me a DM and we can set up a consultation where we just talk about your options, what that looks like, and go from there. So super important there. The next is a debt annihilator, as we call it, right? And say you have, a homeowner in Fort Collins has $30,000 in credit card debt and 22% interest on that, and a $15,000 personal loan at 12%. Well, I don't know much about this, but I know that the primary residence mortgage rates are typically a little bit lower than those numbers. So credit cards at 30K at 22%, you're paying $825 a month, right? Personal loan, 15K at 12%, you're paying about $335 a month. And these numbers are just estimates, but just, that's $1,160 per month that you're paying towards your debt. Now we pull out a $45,000 HELOC at 8.5%, and HELOC rates are very variable because they're based on short-term rates. So that's why we're using kind of different numbers just to give you an idea. So your new monthly payment on the HELOC, where you're going to cover up all that debt and roll it into your mortgage, is $380 for a HELOC that you use that for. Okay, that's a savings of over $9,000 a year in interest alone, but it's all in one, right? And there are some negatives to this, right? If you roll all this debt into your home and something happens, the market crashes and that debt comes down, well, you're eating up that debt and that HELOC's still there. And it is another loan that you do have to pay off, right? This isn't something that sits there and, you're good to go. Now, sometimes there's interest only payments and draw periods and all kinds of things on HELOCs that we don't need to go into, but you need to make sure you understand that pulling a HELOC or doing a cash out refinance both have increases in payments typically as they go, because you have to pay the HELOC back once it's drawn. Okay, at an interest rate that is typically higher than your primary mortgage rate, depending on where the short-term rate is. But you're using this money to get further ahead, to pay less. And so I just caution you not to pull a HELOC out to the max top and then use it all right away to pay off your debt, and then something happens in the market or something happens in your life. Right? I have a cousin that had this and they paid for law school and they rolled it all in and it didn't turn out very well. Right? So you have to be aware of kind of what you're doing here, because ultimately there's a lot of stuff going on and it is taking on another mortgage. It's just technically your quote unquote equity, which is not, liquid asset until you pull a HELOC on it and you're paying interest on that. So just make sure that that's where it is. The next one is, a wealth multiplier, right? Maybe you find a HELOC that you're able to, pull from and use for whatever, or, the HELOC's there and, down the road, you're like, oh, I did this, I did some improvements over here. I have this money I can access. So we're going to do this, buying another property, right? So a Thornton homeowner pulls $80,000, from their equity in some sort of line of credit that you're allowed to do. Okay. It's an 8% loan, 8% interest on that, just for purposes of numbers. You have 20% down on a $400,000, purchase. Now, single family investment purchases typically require 20% down. Multifamily duplexes and above often require 25% down. So we're using a single family purchase here, $400,000. We're taking $80,000 and putting it towards there. Okay, so you have your purchase price of $400,000, your down payment of $80,000. That's your equity that you're using. That leaves you a $2,350 mortgage payment. Right. Well, your monthly rent is about $3,000. Now, I will tell you that $2,350 is just your principal and interest on that loan. So you have to factor in principal or insurance, HOAs, taxes, and those things. Typically, right now, you're going to be at a very even, keel, right? Because if you have a net rental income of $650,000, you're going to be. Or I'm sorry, if you have a net rental income of $650, because that's the difference between principal and interest and what the rent's paying, then you pay taxes and you pay insurance, you're going to be, and then you pay the HELOC, you're going to be very close to a cash positive, cash negative. So why would you do that? Well, at the end of the day, if you feel like it's a good time to purchase a home, you can grow that pretty substantially over a long period of time. Again, it's another long-term play, kind of like, buying real estate is in general. It's not going to be a quick hitter, right? If you want a quick hitter, utilize cash out refinances and whatever you can to do a fix and flip. But there's obviously extreme risk in that if you don't know what you're doing and so on. But at the end of the day, if you step back and you're like, okay, well, this could work. And now I have two properties and this one's paying for itself and the, equity cost here of whatever my monthly payment went up with on my primary, great. Now, the other option is to, get your finances set up, do a cash out refinance, whatever you need to do on your primary residence, and then purchase another primary residence and turn that residence into a rental. That's more of a house hacking thing. There's going to be some positives to being able to move based on you getting a new primary residence loan. Typically, you can utilize, a signed lease or something to offset that debt so that if you, are getting close to the debt to income level rate or the max, and you can utilize a lease to at least cover some of the debt so that you can move forward and go from here. So that's kind of a way to do it. That's pretty much what I did, so to speak. I had a home that I purchased and we did a cash out refinance because it made sense because of the rates at that time. And then I purchased another single family home. Then we took the first home and we sold that. We did a 1031 and bought a duplex. And so we were able to kind of roll all this stuff around and do these things that we're able to collect assets. Now, yes, we have a high long-term debt number. I won't even say it on here. But if you look at our debt to our appreciation, we're pretty positive. Now, I haven't had to do HELOCs and things like that on those properties, but in a tough situation, or if I did want to take that equity and put it somewhere else, we would have options, and that's what real estate long term gives you. And the more assets you have, if they're thought through and taken care of, you can definitely move forward with this stuff. So, and the truth is, as we kind of get down to this, I got really granular there with some numbers, and we'll zoom back out here. But it's a huge opportunity for you. And there's not a lot of people that have huge savings accounts and huge opportunity to leverage more, debt than we have had in the past. And so using leverage and using debt to grow your wealth is pretty awesome. Like, I'm not going to lie, using other people's money to purchase a $500,000 house, and I get a tenant in there, they're paying down my principal, and I'm using someone else's money, right? But I'm also gaining appreciation on the $500,000 purchase price at 4, 5, 6%, whatever that appreciation lands on. And it's growing, right? So 5% of my $25,000 stock investment isn't very much, but 5% of my $500,000 real estate purchase is a little bit more. Now, it's not as immediately accessible as it would be in the stocks, but there's definitely opportunity here. And the bottom line is, everybody has a different situation. That's why I was really general with the numbers I was talking about. But if this is something I'm saying to you, you're like, oh, let's see what we can do, because we're just kind of leveling here, right? And we're paying down principal every month. We're on time on our bills. We're not, collecting a lot of debt. Like, let's see what we can do with this to get to that next level. Or, yeah, we're struggling, right? We're adding up debt over here. We're, breaking even on the house, and that's, but we have that money there. Is there a better way to use it? And I would never say, take money out of this house to pay your mortgage and things like that. That's something we have to talk about on, okay, when do we just cash out and kind of start over and regroup? There's opportunities there as well. But at the end of the day, if you're able to step back, take a look at your options and really understand them fully, it's huge, right? Because some people might say, okay, I can't do a HELOC because my bank's rules, whatever. So I'm going to do a cash out refinance. Well, that could be scary, right? Because the beauty of a HELOC is you're keeping your primary note at the same interest rate as you got it with. Okay. So if you have a 3.5% interest rate and you're taking out a cash out refinance to purchase another property, well, you just jumped your primary interest rate from 3% to 6%. And so you have to understand that those costs are there. Now, I would always include the, extra debt or the extra mortgage cost and the extra or the HELOC or whatever in the overall, picture. So you're not just like maxing out your primary residence to pay for a rental property that's going to break even. So you have to make sure that you're dialed in on that. You have to make sure you are talking to people and not just clicking buttons on a computer. I love AI. I use AI every day, but I will tell you that AI is not the right advisor to help you manage your wealth, and especially when it comes to real estate and different markets and different opportunities and different loan products. So, regardless of if you're in a tougher situation, a good situation, or you're just curious of what it would look like, please reach out to me. We can have a private call. We'll figure it out and we'll look at your specific situation, because not one person who's watching this is going to have the same situation. So I hope that helps. Thank you so much for tuning in to Mile High Mastery Live. And please, 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 if you have any questions or comments, or you want me to talk about something, or you need clarification on something I said, put it in the comments, and then I'll send you a DM and we can go from there. But we'll see you next time. Thanks so much. Bye-bye.